America's R-vee market did not just get a warning, it got called out. Federal investigators, state attorneys general, and consumer regulators have finally stepped into a space that, for years, operated on the edge of what buyers understood. The complaints started small, one buyer at a time. Unexpected fees, confusing contracts, payments that didn't match the offer. Alone, they didn't move the needle. But together, they painted a picture the federal government could no longer ignore. What's been uncovered isn't just dealer behavior. It's a market-wide structure built on silence. Now that silence is breaking, and what comes next could force a correction bigger than most buyers expect. When a normal deal becomes the first warning sign, most R-vee buyers walk onto a lot thinking the hard part is choosing the rig. The real complexity starts after that, a discounted sticker price. A salesperson repeating phrases like below invoice and limited availability, and a sense of urgency that feels routine in today's market. Nothing unusual so far. The shift happens in the finance and insurance office. Buyers are presented with polished menus, good, better, best loaded, with extended service plans, interior and exterior protection packages, preferred customer bundles, and administrative fees that sound standard but rarely get examined closely. It is framed as customization, not upselling. In reality, this is where the structure behind the deal reveals itself. The monthly payment often includes products never explicitly requested, paired with an interest rate a buyer has no reason to question. On paper, everything seems typical. In practice, this typical layout hides the mechanisms that have now triggered federal attention. Regulators began noticing the same themes: unexplained fees, loan terms that did not match conversations, protection packages costing more than major mechanical components, and consistent jumps between advertised prices and final contracts. These warnings mounted quietly for years across multiple agencies. As recreational vehicle prices climbed and loan terms approached small mortgage territory, the pattern finally became too visible to ignore. Data showed R-vee buyers, often older and tapping retirement savings or home equity, were being hit with higher financing markups and denser add-on stacking than car buyers. Clusters of nearly identical complaints pointed to something systemic, not isolated. When investigators pulled sales scripts, menu structures, and lender data, the truth became clear. This was not a few dealerships bending rules. It was a model, and the money trail led into a side of the industry most buyers have never been told exists. One that explains why the pressure feels identical no matter which lot you visit. The hidden forces shaping every number on the contract. Behind every R-vee sitting on a dealership lot is a ticking financial clock. Dealers rarely purchase their inventory outright. Instead, they use revolving credit lines, floor plan financing from lenders. Each recreational vehicle arrives already tied to debt. A grace period follows, where interest is low or deferred, but only for a short time. As the days pass, the cost of holding that rig increases. Interest tiers rise. Inventory reports highlight aged units that have been on the lot too long. Internal notes speak of turning those units before the holding costs wipe out the expected margin. This pressure creates an incentive. Do not discount the front-end price too deeply. Instead, make up the difference somewhere else. Finance products, add-on bundles, rate markups, and fees that look standard but exist mostly to plug holes created by the cost of carrying inventory. Floor plan financing itself is not improper. It is a normal business mechanism. The problem arises when that invisible clock pushes staff toward tactics that regulators say blur the line between assertive salesmanship and deception. And that line becomes clearest inside the finance and insurance office. Modern R-vee dealerships treat that office as a structured profit center. Buyers are presented with menus featuring basic, preferred, premium, and ultimate packages, each anchored to a monthly payment rather than a total price. Those packages may include extended service contracts, guaranteed asset protection coverage, tire and wheel coverage, protection coatings, theft deterrent programs, and bundled convenience services. While the finance manager explains these items, the software quietly adjusts the loan term and the interest rate to keep the payment in the range the buyer mentioned earlier. The buyer's focus stays fixed on the comfort of the monthly number, not on the added interest or inflated total. Training materials uncovered in investigations encouraged this exact framing. Products were to be presented as near standard. Declining them was portrayed as neglecting basic responsibility. Under those conditions, saying yes becomes easier than asking what each item costs, and that sets the stage for the part of the deal most buyers never question. Yet, it can add thousands over the life of the loan. If this breakdown has raised questions about your own R-vee deal, or if you've seen tactics like these firsthand, drop a comment below. Your story or question might help someone else avoid the same trap. And if you're finding value in understanding how this market really works behind the scenes, hit the like button so others can find it too. Subscribe if you want to stay ahead of the next pricing shift before it shows up on the lot, because once it is public, it is usually too late to act. When your interest rate is not really your interest rate, most buyers assume their loan rate comes straight from the bank or credit union. The lender looks at their credit, approves a number, and that is that. In reality, another step is often hidden in the middle. The lender sends an approval called a buy rate. That is the minimum annual percentage rate the borrower qualifies for. The dealer then has the option to add a markup on top of that buy rate. The difference between the lender's number and the number the buyer actually sees becomes extra profit, shared between the dealer and sometimes the finance source. Here is what that looks like in real terms. Imagine a lender approves a buyer at 6.5%. The dealership system allows up to 3% added on top. The finance manager quotes 8.5%, framed as a good rate in today's market. Over a long R-vee loan, that 2-point spread can add thousands of dollars in additional interest. Now, layer in the menu items that were quietly rolled into the loan amount. The buyer ends up paying interest not just on the recreational vehicle itself, but on a package of products they might never have chosen if each had been shown with a simple cash price and a clear yes or no choice. Regulators flagged this combination as the heart of the scandal, payment packing and rate padding working together, obscuring the true cost of the deal. The law does not forbid profit. It does insist on clarity and truthful disclosure. When buyers are never told their actual approved rate, or that they can decline markups and add-ons, transparency collapses. And that raised a new question. Why did manufacturers not step in sooner if this was how their products were being sold? Why the factories looked away while the back end swelled? From a manufacturer's perspective, the goal is straightforward. Build units, ship units, move units. Volume is king. To support that volume, many recreational vehicle brands structure incentive programs for dealers. These include holdbacks, bonuses for meeting quarterly targets, and extra payouts for pushing certain models. On paper, this looks like simple motivation, but when you pair those incentives with floor plan pressure, an interesting pattern emerges. Dealers are encouraged to advertise aggressive prices to keep units flowing. Online listings feature deep discounts that barely leave room for profit on the front end. The expectation is that the difference will be made up elsewhere. Finance products, rate markups, and line items on the buyer's contract that never show up on a manufacturer's price sheet. Internal communications that surfaced in investigations did not always spell this out in blunt language, but the themes were consistent. Protect finance profit, maximize back end. Do not train customers to expect heavy discounts on the advertised price, because that undermines perceived value. In that environment, transparent, no-nonsense pricing can look like leaving money on the table. And as long as buyers signed contracts and the rigs rolled out, the factories got what they wanted: volume and market share. It took sustained complaint patterns and regulatory scrutiny to force a closer look at how that volume was being achieved and what it meant for the people signing 2-decade loans. When that look finally came, the response was not gentle guidance, it was enforcement. What the United States government actually did. Government action in this space did not arrive as one press conference and a single giant penalty. It unfolded as a series of linked moves. Regulators targeted specific dealer groups whose patterns looked worst on paper: unusually high average interest markups, dense clustering of costly add-ons, and complaint histories that showed the same concerns over and over. They examined agreements between dealers and finance sources. They read scripts and training materials used in finance and insurance offices. From those cases, several themes emerged in the public orders and guidance that followed. Dealers would now be required to show, in writing, the actual buy rate from the lender and the final rate offered to the customer, making the markup visible instead of invisible. Add-on products would need clear written consent with line item prices. No more burying extended service contracts inside a total payment without calling them out explicitly. Certain fees that provided no identifiable service beyond pure dealer profit were labeled as junk fees and either restricted or required to be clearly presented as negotiable, not mandatory. Some enforcement actions included restitution restitution funds for affected customers, allowing people who financed during specific time windows to seek partial refunds on undisclosed products or inflated rates. None of these steps outlawed making a profit on financing. What they challenged was the method, profit that depended on customers not understanding the structure of their own deals. The moment those structures became public, another layer of the market began to shift. When advertised prices start to mean something closer to reality. During the first weeks after enforcement actions hit the news, most buyers would not notice anything dramatic driving past a lot. The same flags waved, the same seasonal sales banners hung from the same fences. The changes happened in quieter places. Website teams revised small print. Some dealers removed or renamed fees that had attracted regulatory attention. Others changed pre-printed contract forms to pull certain add-ons out of the standard column and into optional checkboxes. At the desk level, finance managers became more cautious about how they presented products. Some began placing greater emphasis on disclosure forms. Others shortened the menu, realizing that a smaller set of offerings, clearly explained, was safer than a long list of highly profitable but legally risky additions. For buyers who understood what was happening, this created a strange moment. The gap between the price on the online listing and the final all-in price began to narrow. Not everywhere, and not consistently, but enough that thorough shoppers started noticing that some stores had less mystery meat in their contracts than others. In that kind of environment, those who are paying attention can do something powerful. They can choose to reward transparency, and that choice, multiplied across many deals, becomes part of the new pressure on the industry. While that front-end adjustment was happening, something more painful brewed in the background: the used market, the hangover. Used values and upside-down loans. For years, inflated new unit pricing helped hold used values higher than they might have been in a more transparent market. When buyers paid a premium at purchase, they anchored their expectations for resale around that premium. Listing sites filled with used R-vees priced according to what the seller still owed, not what the rig might command in a stripped-down, cash-only scenario. As regulators pushed practices into the light and dealers adjusted, transaction prices for new rigs began to drift closer to the actual hardware value plus a straightforward margin. Once that happened, the ladder beneath used prices started to shake. Owners who had financed heavy back-end products and padded interest rates found themselves more deeply underwater. Negative equity, already common in long-term recreational vehicle loans, deepened as the market corrected downward from inflated levels. Regulators understood this risk. It was part of what had drawn them in. Households locked into decade-plus loans on assets that could be worth far less in a corrected market than the balance on their contracts. The unfortunate reality is that correction pain rarely spreads evenly. New buyers entering the market under clearer rules stand to benefit. Recent buyers who signed at the peak of opaque practices may see their positions worsen before they improve. Yet even in that landscape, some of those recent buyers now have leverage they did not have before, who might actually see money back. When enforcement actions and settlements become public, they sometimes include more than fines paid to the government. They can create funds or pathways for consumer relief. In this context, that relief typically lands in a few forms. There may be targeted restitution for customers who bought through specific dealerships or finance programs named in an action. Those customers receive letters explaining that their deals included practices regulators deemed deceptive and are invited to claim refunds on certain fees or products. There may be broader funds covering particular time frames, allowing any buyer who financed with a named lender or dealer group during those windows to submit contracts for review. In those reviews, investigators look for patterns, add-ons a customer claims they did not knowingly authorize, rate spreads that do not match disclosed terms, or junk fees added without clear explanation. Not everyone will receive a check. Relief is often limited, both in scope and in dollar amount. But the existence of these mechanisms means R-vee buyers now have something they did not have before: a documented record of what regulators consider unacceptable. That record can be powerful even for those outside a specific settlement. It shifts the standard for what a fair deal looks like on the next purchase, how to walk into your next deal with your eyes open. So what does all of this mean if you are still thinking about buying a recreational vehicle? It starts with separating three things that dealerships often blur together: the price of the rig, the cost of the money, and the value of the extras. First, treat the recreational vehicle itself as one decision. Negotiate the out-the-door price in writing. Before anyone talks about financing, that written number should include taxes and unavoidable government fees, and it should list any dealer-installed accessories you actually want. Second, bring your own benchmark for money. Before you ever step into a finance and insurance office, get an approval from a bank or credit union. If your credit union offers a pre-approval at, for example, 7%, you have a reference point. When the dealer offers you a rate, you can compare it to your pre-approval and ask a crucial question: what did the lender actually approve me for? Ask for the buy rate in writing. You may not always get it, but simply asking signals that you are not approaching the loan as a mystery. Third, break the extras apart. When a finance manager presents a bundle of products, ask them to list each one separately with its individual price. Extended service contracts, guaranteed asset protection, tire and wheel packages, and appearance protections all have real costs, and in some cases, real value. The scandal is not that these products exist. It is that they have often been smuggled into deals without informed consent. Ask calmly whether you can purchase an extended service contract later, directly from the provider or at a future visit. Ask whether guaranteed asset protection is still necessary if you make a larger down payment. Ask what exactly the environmental protection actually does, and whether your rig's original materials already carry a factory warranty. Finally, pay attention to fees. Administration, documentation, and processing fees should be explained in plain language. If they are not tied to real costs, consider them negotiable. You do not have to argue. You only have to be willing to walk away if the answers do not make sense. In a market under regulatory scrutiny, that willingness is more powerful than ever. How this could quietly reshape travel and housing choices. Recreational vehicles have long sat in a strange space between luxury and necessity. For some, a rig is a rolling vacation home. For others, it is a cheaper way to live near seasonal work, to travel between family members, or to escape escalating rent in a metropolitan area. As airfare, hotel rates, and conventional housing costs continue to climb, the idea of using a compact RV as a flexible living tool has become less fringe and more mainstream. The scandal around financing and junk fees put a heavy thumb on that scale. It pushed real ownership costs higher than many buyers realized, turning what looked like a path to freedom into a long-term drag on their budgets. If the recent government actions succeed in shaving away the opaque layers of profit, what remains is closer to the actual cost of the hardware, and a transparent margin for the dealer. That does not magically make rigs cheap, but it does make the math more honest. Over time, this could make the choice between renting a small apartment and financing a modest recreational vehicle a clearer calculation, not a gamble against hidden interest and products buried in fine print. But this clarity will not last forever. Markets adjust. New tactics replace old ones. The brief moment when old structures have been exposed and new ones have not yet fully formed is a rare window. The people who understand that window tend to benefit the most, the brief window, when knowing the playbook matters. After a shock like this, the market tends to move in phases. At first, many dealers react defensively, cleaning up the most obvious problem areas, tightening compliance, and sometimes slashing prices on aging inventory to avoid further scrutiny. Discounts appear on rigs that have sat under heavy floor plan interest, because holding them any longer becomes too costly. As weeks turn into a couple of months, a new normal starts to take shape. Dealers refine their scripts, software vendors tweak their tools to emphasize disclosure, and manufacturers quietly adjust incentive programs. Profit strategies do not disappear, they adapt. Eventually, the most aggressive practices that regulators targeted fade, replaced by approaches that sit closer to the legal line, while still supporting margins. The unique leverage that well-informed buyers hold in the immediate aftermath begins to soften. That is why understanding not just that a scandal occurred, but how it worked matters. If you are shopping during this period, you can watch for certain telltale signs. Contracts that clearly separate rig price, lending terms, and add-ons. Finance managers who are willing to match or beat outside rate approvals without hesitation. Dealers who itemize fees and explain them without defensiveness. Those are green flags. Red flags, even now, include pressure to focus only on monthly payment, resistance to showing the buy rate, and confusion when you ask whether an add-on is required or optional. The more people ask those questions, the harder it becomes for any store to slip back into old habits unnoticed. And that leads to the real question at the heart of this entire story. The question you have to ask before your next RV deal. The scandal in America's RV market was never just about inflated prices or long loan terms. It was about information, who had it, who didn't, and how that imbalance shaped every signature on every contract. For years, the most critical parts of the deal lived in places buyers rarely looked: back-end menus, lender rate sheets, bundled add-ons, and fee structures designed to appear routine. Most shoppers never saw the real architecture behind their monthly payments. Now, for the first time in a long time, that architecture has been dragged into the light. Federal agencies and state regulators have exposed practices that were once considered standard, even expected inside finance offices. But that exposure won't freeze the market in place. The light will fade. Dealers will adjust. Lenders will rewrite guidelines. New tactics will replace the old ones, shaped carefully to fit inside the updated rules. That means the deciding factor going forward isn't the industry, it's the buyer. So the real question is this: when you walk into your next recreational vehicle deal, will you assume the process still works the way it always has? Will you trust the monthly payment presented to you, accept the bundled products, and sign where the finance manager points? Or will you enter that office with the expectations that force clarity itemized add-ons, written rate disclosures, and a total out-the-door price that actually reflects what you intend to buy? Because the moment you ask the right questions, the entire structure of the deal shifts. If you want to stay ahead of the next pricing correction or regulatory move, share your experience in the comments. Your story might highlight a pattern others need to see. And make sure you subscribe so you do not learn about the next major market shift only after you have already signed a contract shaped by it.